Elon Musk might just be gearing up for what is, without a doubt, the single biggest financial launch of his entire career. Welcome to This Explainer. Today, we're digging deep into the underlying investment thesis behind the swirling reports that SpaceX could soon go public. And listen, this wouldn't just be another company ringing the opening bell. We are literally talking about what could be the largest initial public offering in American history. But behind all the massive hype and the incredibly cool rocket launches, retail investors really need to understand the absolute fundamentals before putting their hard-earned capital on the line. I mean, is SpaceX genuinely the ultimate future of global tech, or are we looking at the next massive Wall Street risk? As an investor looking over a potential prospectus, you've got to know exactly what you're buying into.
Okay, let's dive into this. According to recent financial reports and IPO filings, SpaceX is prepping for a public market debut under the reported ticker symbol SPCX. And the valuation estimates, they're placing the company at nearly $2 trillion. $2 trillion. That's not just a staggering number. It instantly puts SpaceX in the exact same heavyweight class as Apple, Microsoft, and Saudi Aramco. Honestly, it's completely unprecedented for an IPO. But here's the advisor's reality check. It means this stock would be priced for absolute perfection right out of the gate. Any missed target, any slight revenue shortfall post-IPO, and the market is going to punish it immediately.
So to make sense of this massive prospectus, we're breaking this explainer down into 5 key areas. 1. The trillion-dollar debut. 2. Starlink and AI growth. 3. The profitability problem. 4. The Musk control factor. And 5. The retail investor verdict. Starting with part 1, the trillion-dollar debut, beyond just rockets. Moving right along to part 2, Starlink and AI growth, fueling the valuation. Now, what's really interesting about this slide is that if you're evaluating this IPO purely as a traditional aerospace company, you're missing the whole shebang. You're missing the bigger picture of a deeply connected tech empire. To justify a $2 trillion price tag, Wall Street absolutely demands massive, reliable revenue engines. And, surprise, the biggest source of revenue actually isn't the lumpy, totally unpredictable business of launching hardware into orbit. It's Starlink. This global satellite internet network is doing the heavy lifting right now, generating more than half of the company's recent revenue. And from a financial perspective, here is why that matters. Starlink provides recurring subscription revenue. That is the absolute holy grail for tech valuations. It flips their financial profile from a capital-heavy aerospace manufacturer into a predictable, software-like business. And that right there is what justifies those massive valuation multiples. So where is all that sweet recurring revenue going? Well, it's funding an aggressive expansion that forms the very core of the bull case growth narrative. They're pouring billions into Starship to build out planetary infrastructure. But crucially, and this is a huge deal for the tech sector, they are spending heavily on artificial intelligence. Integrating Elon Musk's XAI division is definitely not just some side project. It creates this massive feedback loop where space infrastructure processes global data in real time, effectively turning the entire Starlink constellation into a giant edge computing and AI network. This is the synergy that shifts the whole valuation model from a standard aerospace company to a hyper-growth tech platform. Which brings us to part 3, the profitability problem, the reality of cash burn. And this brilliantly illustrates what any cautious financial advisor will tell you to scrutinize, the capital expenditures, or CapEx. Look, expanding artificial intelligence and building out the massive Starship infrastructure requires historical levels of cash burn. Despite the huge growth projections, filings reportedly show major financial losses tied directly to that heavy infrastructure and AI spend. So we've got this high-growth tech story slamming into a highly capital-intensive reality, and it's heavily pressuring their operating margins. Building the future is incredibly expensive, guys, and those costs eat right into the bottom line. This brings us to a really crucial metric, the cash runway. Analysts believe the company's entire future hinges on these extremely ambitious goals eventually yielding actual sustainable profit. Remember that $2 trillion valuation? Massive growth is already entirely priced into the stock. If this heavy infrastructure spend doesn't start producing immediate, scalable profit, the valuation multiple is going to contract sharply. Basically, the high cash burn has to be resolved, or that $2 trillion figure simply won't hold up. Next up, part 4, the Musk control factor. Who holds the keys? Typically, when you buy a share in a public company, you expect to have at least a little say on how it's run, right? Well, reports suggest that even after the IPO, Elon Musk would maintain enormous voting power through a dual-class share structure. These super voting rights basically allow a founder to raise public capital while maintaining a total veto over the board of directors and major corporate decisions.
So retail investors might be the ones providing the capital, but the founder retains absolute control of the steering wheel. As you can imagine, this governance structure creates a highly polarizing debate among market watchers. On one side, supporters view this as a necessary founder premium. They argue that if you're going to invest in a generational visionary, you have to trust his leadership. After all, it's the very foundation of the company's success so far. But then you have the critics, and they are warning of severe key person risk. They point out that this concentrated power leaves minority shareholders entirely exposed to the whims of one individual. If things go wrong, you have virtually no legal recourse and no voice in the company's direction. And finally, Part 5, the retail investor verdict: dominance versus volatility. Online discussions are already completely exploding across investing communities, and there is a very real threat of regular investors being left holding the bag. While some users firmly believe the company is just going to completely dominate the future of space and AI, others are definitely sounding the alarm. As one Reddit investing community warned, regular investors could face extreme volatility if expectations become unrealistic. And they hit the nail on the head. Retail investors are often the very last to enter the hype cycle. If institutional investors suddenly decide the AI and Starlink growth isn't matching the immense cash burn, it's the retail investor who's going to absorb the brutal, sweeping volatility of the market.
Ultimately, we have to realize this IPO isn't just another tech offering. It's a massive referendum. It's a highly public test to see if Wall Street actually has the patience to simultaneously fund private, multiplanetary space exploration and massive AI infrastructure. If it succeeds, wow, it could fundamentally reshape American innovation across multiple sectors. But if it struggles, it's going to be one of the most closely watched financial experiments in modern history.
So weighing a $2 trillion tech and AI empire against the stark realities of heavy capex, massive cash burn, and absolute key person risk leaves us with a pretty critical decision. Are you buying into a multiplanetary AI-driven monopoly, or are you funding the most expensive, high-risk science experiment in Wall Street history? You've got to take a really hard look at the fundamentals before you invest. Thank you so much for joining this explainer, and definitely keep a close eye on the markets as this historic debut gets closer.